Take a look at a modern multinational corporation. It is a highly complex, chaotic system of daily operations, moving millions of dollars in inventory, labor, and capital at high speed. To the outside world, this daily activity is almost entirely opaque. The internal users, management, and the board of directors, investors deciding where to put their money, creditors determining lending terms, financial analysts evaluating stock, and regulatory agencies monitoring compliance. To make these decisions, external users have to answer a specific set of questions. They need to evaluate the firm's liquidity, measure its long-term solvency, and gauge the actual probability of the firm securing future financing. That need defines the entire objective of general-purpose financial reporting. The goal is to take that chaotic operational reality and deliver standardized, useful information so these external parties can confidently allocate their capital. The solution to bridging this gap is a strict reporting ecosystem. Every piece of public financial information must be prepared in conformity with generally accepted accounting principles, or GAAP. These reports function as precisely engineered predictive tools, allowing external users to forecast future capital allocation based on standardized data. This layout displays the exact framework GAAP mandates. A complete set requires 5 documents: the Statement of Financial Position, Income Statement, Statement of Comprehensive Income, Statement of Changes in Equity, and Statement of Cash Flows. Beneath them lies a mandatory bedrock, the going concern assumption. The going concern assumption states that the reporting entity will continue operating indefinitely. It assumes the business will not be liquidated in the near future. This assumption is required because it strictly dictates asset valuation. If a company were liquidating tomorrow, its assets would only be worth their fire sale price. Assuming indefinite operation allows accountants to value long-term assets based on their ongoing utility to the business. The numbers on these pages represent only part of the reporting requirement. They must be accompanied by detailed supplementary information, primarily found in the financial statement notes. These notes are not optional reading. Under GAAP, they are an integral, required component of the basic financial statements. In fact, the very first footnote accompanying any complete set of financials is strictly reserved for describing the company's significant accounting policies. This footnote details the exact rules management used to generate their numbers. It must cover their use of estimates, exactly how they recognize revenue, and the specific methods used to allocate the costs of both tangible and intangible assets over time. Without the going concern foundation and the rigid disclosures in the footnotes, the raw numbers on the 5 statements lack context. They become isolated figures rather than the standardized data external users need for accurate evaluation. To maintain that standard, GAAP enforces an uncompromising rule. Public financial statements absolutely cannot be prepared under the cash basis of accounting. Under the cash basis, revenues are only recognized when physical cash hits the bank account, and expenses are only recognized when cash leaves it. The flaw here is timing. A company could deliver a massive, highly profitable project in the month of December, but if the client pays in January, a cash basis system shows 0 value created in December. Cash timing rarely matches economic value creation, making it impossible to evaluate management's true performance. GAAP mandates the accrual basis of accounting. We see the difference on this split-screen timeline. Rather than tracking isolated bursts of cash moving on the top, accrual accounting tracks the smooth blocks of actual economic operations on the bottom, recording effects precisely when they occur. This relies on the revenue recognition principle. Revenues are recorded strictly in the period they are earned, regardless of a delayed cash receipt. That revenue is then locked to its costs through the matching principle. Expenses must be recognized in the exact same period as the related revenue they help generate. This matching is governed by strict rules. The result merges these locked expense and revenue blocks into a highly accurate performance metric for that specific period. Users have to separate these actual operational performance changes from mere financing events. The income statement maps this operational performance, while events like issuing new debt or equity are isolated on the balance sheet. By tracking the true operational return on economic resources, investors can accurately strip away financing noise and evaluate how management is running the core business. Accrual accounting is the required engine of GAAP because it forces financial reports to reflect economic reality. It completely neutralizes the arbitrary, easily manipulated timing of cash transfers. Look at this node-based network graph representing the 5 statements. They do not operate in isolation. They are bound together by articulation, the fact that financial statements complement each other, describing different aspects of the exact same transactions. Because of this, no single statement is sufficient on its own. External users must analyze multiple intersecting statements to gather the complete data needed for a specific economic decision. Let's trace the first core relationship. Data moves directly from the income statement into the equity section of the statement of financial position, or balance sheet. Specifically, the final net income or loss mathematically accumulates into the retained earnings account. From there, we trace a second relationship. Those equity items on the balance sheet mathematically reconcile with the balances on the statement of changes in equity. The third core relationship involves cash. The cash and cash equivalents line on the balance sheet links directly to the final output calculated on the statement of cash flows. A fourth relationship links inventory. The current assets reported on the balance sheet feed directly back into the income statement. The value of that ending inventory strictly dictates the mathematical calculation of the cost of goods sold. And the fifth relationship involves asset degradation. The amortization and depreciation expenses reported on the income statement directly reduce the asset and liability balances on the balance sheet. This mathematically interlocking network prevents isolated misstatements. If management artificially inflates an asset on the balance sheet, the math inherently forces a corresponding misstatement on the income statement. The articulation secures the integrity of the whole system. We have a structure built on the going concern foundation, powered by the accrual engine, and locked together by a 5-statement articulating network. This rigid architecture exists to guarantee 2 mandatory qualitative characteristics: relevance and faithful representation. The data must matter to the decision, and it must accurately depict the economic substance of the firm. When every firm uses this exact same architecture, it creates comparability. Users can line up the data and understand exact similarities and differences between entirely different entities, or track a single entity across different time periods. This comparable data allows external investors to evaluate the variability of returns, calculate risk, and predict future returns with mathematically grounded confidence. This highly engineered, mathematically constrained reporting ecosystem provides the structural integrity required to safely direct the flow of global capital.